Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Back in the headquarters here today, doing a first live broadcast on YouTube for our podcast here.
Yeah.
And very excited today, Ez. Welcome back into the studio.
Yeah, it's a full house today. We got the whole family in here.
And I don't know if you knew this or not. Probably should have let you know ahead of time. This is actually my birthday today. 36 years on this earth.
That's amazing.
Yeah. Hopefully I don't look 36.
Happy birthday.
Or maybe I should. I don't know. Thank you. Appreciate that.
I'm not sure what 36 looks like, but you're nailing it.
It's all the coffee, you know.
Yeah.
Very high caffeinated
Keeps
kind
that
of
skin
diet.
tight.
Yeah, absolutely. Well, you kind of got to be on a lot of caffeine these days, given the fact that we're just getting drilled with all kinds of economic data news. We got Powell in front of Congress just getting peppered with questions.
It's relentless.
It's like drama every day, every time you turn on the news, and it's good for us. I mean, this is really what being an advisor is all about, is kind of helping people navigate these sort of waters.
Yeah.
A lot of questions from clients and people that really enjoy the show. So we're going to talk about some of those things here today, about how we're positioning ourselves ahead of all the data that's coming out really tomorrow. On Friday, March 10th at 8:30 in the morning, we're going to get a new jobs report. So I'll talk about that here in just a little bit more detail. And then all of next week, we have nothing but alphabet soup on an inflation data standpoint. CPIs on Monday at 8:30. Then you got PPI, CPE. Like, it's going to be a wild week. But if the numbers come in the way that we're expecting them to, and again, we're going to talk about this a lot here today, we're going to look pretty good.
Yeah.
I might look like I know what I'm doing here. You know what I'm saying?
Well, 2023 is turning out really well for you in that regard. So hopefully that streak continues. That's good for all of us if you're right. So.
Absolutely. Absolutely. So wanted to start out this show here today. And before we even get into it, for the people that may be watching the first time here, welcome to the show. Thank you for joining us. Hopefully you get a lot out of this, and you can like and subscribe and get the notifications sent to your phone and email directly from YouTube or Spotify every time we drop a new show. But the reason why we do all this stuff is I know for sure that clients and people that are watching the show today are checking out CNBC like I do, or they might be reading Barron's or New York Times or whatever your favorite news outlet is to kind of get the information about the markets and the economy in general. The news does a good job of telling you what's going on right now, but in my view and my clients' view, they've always done a very poor job of giving you historical precedents of similar events that have also happened in time and history.
Right.
And the reason why I feel like that's so important to take a look back at what history has to say is because the market's just a bunch of human beings. And the best investor of all time, Warren Buffett, who's outperformed the market by 2x over the last 60 years, he famously said decades ago that the one thing we know for sure about human beings is they do not learn from history.
No, we do not.
And I think there's a lot to learn from history as it relates to the market, because they tend to repeat themselves over and over and over again. So when we take a look at what history has to say during similar events, now we can begin to position ourselves accordingly in anticipation of what may occur again, history repeating itself over the next 6, 9, 12 months, or even longer. Now, for all the regulators out there watching the show, past performance is no guarantee of future results. However, I'm going to take the words of wisdom from Mr. Warren Buffett and actually take a look at what history has to say before I make some educated decisions with the portfolio.
Well, I had a real jerk principal in high school tell me, Ezra, you can't ever be too prepared.
Exactly.
So I feel like all the data is good data, right?
Yeah. Well, actually, these days, good news is bad news.
Yeah.
In a lot of circumstances. So, and what I say by that, so the last jobs report that we had in January, obviously that news didn't come out until February. And I think economists were expecting at the time around 200,000 jobs, and we showed like 517,000 jobs. So in that moment, I'm like, yeah, I mean, I'm proud to see that kind of result here in the United States, 50 plus year, low unemployment rate, 3.4%.
Yeah, you love it.
But that's actually a bad thing for the market when that happened in February, because it gave the Federal Reserve a lot of reasons to consider and continuously increasing interest rates and hold them at that higher level for longer, which is the rhetoric that we saw from Mr. Powell over the last 2 days in front of Congress. So good news was bad news in that example. However, that was a seasonal, type of jobs report, right? A lot of people get part-time work and so forth around the holidays, beginning parts of the year. So that should be taken with a grain of salt. Tomorrow, though, is really what we're really excited about from a job standpoint. So this morning, here's the reason why we're excited. The labor market initial jobless claims rose 21,000 to 211,000 the week ending March 4th. And the jobless claims were above the 200,000 that we saw in January. So in this instance, more people have jobless claims, which is unfortunate, but is actually that bad news is good news. That's the reason why the market recovered from this morning. It was actually negative across the board on the S&P, Dow, and the NASDAQ before the market opened. And now we're seeing, modest gains. It's not like it's ripping off to the right here.
Yeah.
But if we get tomorrow's job report, which economists are expecting about 211,000 jobs for tomorrow's print that we'll get at 8:30 in the morning. And if we get something on par or below that, it's going to be an excellent Friday for the stock market. And then again, next Monday, if we come in line or lower than inflation expectations, which that's kind of where my camp is, we kind of expected to be a little bit lower.
Right on.
Then again, we're going to have a very nice rally, I would say, not just for next week, but probably getting all the way into April, mid to late April. So very, very excited about all the things that are coming. And if we're wrong, we're going to have to do some rebalancing. No question about that. But the data is suggesting that we're trending in the right direction here. So I'm very, very excited to see what the actual news is. And with that, I wanted to transition into, so that's what's coming. That's what's already happened here. So I think you all know by now, for those that have watched the show for a little while, I send out a monthly newsletter to all clients. And by the way, we're coming out with a exciting piece of news here. The Shepherd Wealth Management is going to be launching its first mobile app.
Yeah.
And we're very excited about that.
Joining the 20th century.
Absolutely. Yeah. I was doing a lot of coding, at night. No.
Boot camp, coding boot camp.
Coding for dummies got me through, creating that app. No, I actually had to outsource that, but it's very cool. And we're very excited. It's not launched yet. I'm actually waiting for the green light there. We told them to turn it on.
Yeah.
And I don't know how long it takes for iOS and Android to have that show up on the App Store. But when it is live, obviously, we'll let everybody know. And we're going to make those that have the mobile app on our website, you'll be able to check out every newsletter that we've ever done. We're also going to start doing a blog.
Oh, nice. An
every
archive,
week.
huh?
Absolutely. So it's not just going to be for clients anymore. It's going to be for everybody.
That's awesome.
Yeah. So everybody can benefit from, the data that we have. And that way people can understand, what we're thinking and why, and what data that we have to support, our position.
Yeah, maybe that's a good time to remind everybody who's listening that you don't have to be a current client of Shepherd Wealth Management to come in with your questions on the show. So if you got anything you want to add to the chat or drop in a comment below on a video archive if you're watching this later, Joshua will get back to you.
Absolutely. And getting into the bull-bear debate here. All right, so we got all this data coming up, and I kind of wanted to just go over some bullet points of what I've heard from clients and just people in general. Right, I'm walking around Cincinnati, Northern Kentucky with my Shepherd Wealth Management shirt. I get questions. All right, so here's some of the questions and my responses to that. So there are many reasons why investors remain bearish, and we certainly understand that. And one of the bullet points here for the bear case is, hey, inflation is still too high. This means the Fed's still waging war against inflation. And of course, our view is that inflation is falling. And that's what we're going to be getting a better indication of next week.
Yeah.
We've already gotten really good indications of that already. Over 34% of the data points that they use to calculate things like CPI, they're flat out deflationary. And that was actually evident in Powell's last announcement to everyone. He used the word disinflation 13 times.
13. Yeah, after not using it once for an entire year.
Absolutely. So our view is inflation is in fact falling. And there is no crisis related to inflation in 2022. Now, again, the bear case would be, another one would be, hey, the yield curve's inverted.
Yeah.
And it's coupled with Fed, hiking, which means a recession is inevitable. So when we use the word inevitable, when everybody's saying, hey, 2023, we're going to have a recession, this would be the most anticipated recession in the history of mankind.
Yeah, it's like the sequel no one wanted. We can't wait for this recession.
Right. It's almost like people are like, all right, let's just get it over with. We're going to recession. I'm just going to deal with it. And I'll just sit out in a 3-month treasury. Right.
Yeah.
That's what we're hearing a lot. Now, I agree with you that the yield curve has been inverted for quite a while.
I believe you've been mentioning this for quite a while.
Yeah. Here's my response to that. So inflation is expected to be higher 1 year and 2 years forward versus 10 years out. So this has to show up in bond yields. Also, the high Fed funds of today doesn't mean rates are this high 24 months later. Hence, the 2-year Treasury can be below the Fed funds rate. So that's the reason why the 2 year is so much giving a higher yield than the 10-year, is because the market is expecting inflation to be higher over 1 to 2 years versus the 10-year. Now, obviously, this can change very, very quickly as inflation's falling, and inevitably that will cause the Fed to reconsider their position of hiking rates to pausing most likely first, and then hopefully sometime later this year, beginning of 2024, they're starting to reduce rates. Now, the next one is an interesting one I hear most often, is that earnings estimates are falling. Hence, stocks need to go down, plus valuations are high, right? We get that quite a bit. Here's our response to that. Stocks actually bottom. If you look at history, stocks bottom, the market bottoms 11 to 12 months on average before earnings per share estimates bottom, right? And the market bottomed last year. So I would argue that, yeah, we've had an inverted yield curve for all of 2022. And I don't think that earnings are the issue here. That should not be the focus. Actually, earnings have held up quite nicely. They haven't been robust,
right,
but they certainly have not fallen off a cliff by any means. And with the market last year, 2022, bottoming, that falls right in line with what history has to say. The market bottomed 11 to 12 months before earnings per share bottom. And if you actually look at the valuations of the overall S&P 500 and you take out the big FANG names, the Facebooks, Meta, Alphabet, Amazon, Google, Netflix, if you take those FANG stocks out of the S&P, which are the biggest holdings, right, biggest weightings, the PE ratio going forward into 2024, and you got to look, the market's looking forward, right? 2022, the market was down 20% on the S&P 500, and earnings were positive. We had earnings growth in 2022. Earnings are slowing now due to the fact of the Fed increasing rates that high. So the market's now looking forward into 2024. What is 2024's earnings actually going to look like? Well, if you take out all those big FANG names, the S&P 500's forward PE ratio, looking into 2024, is 14.8.
Okay.
The historical long-term average for the S&P's PE ratio is like 16, 17%. So this is hardly a demanding hurdle here at 14.8 forward PE ratio on the market. The market is, again, looking forward to 2024 earnings. In 2022, again, earnings were positive, but the market was down 20% because investors were concerned about 2023 earnings and how they would look, right? So I actually would argue that we're setting up pretty nicely here from a rally standpoint, with earnings not being robust, but certainly holding in there pretty nicely. And the big one also, after we talk about, inflation and interest rates and earnings, the next one would be, hey, inflation will come roaring back because China will consume oil and the Russia-Ukraine war is still raging. It is unfortunate that the war is still raging in Ukraine.
Yeah.
And certainly heart goes out to everybody over there.
It's horrifying.
Yeah, it's frustrating to say, at the very, very least. That's not even a good word for it at all. But as it relates to this position, I guess, that an individual investor might have, here's my thought to that. These are definitely inflationary shocks. War is an inflationary shock, no doubt. However, there have been multiple cascading shocks that caused the 2021, 2022 inflation surge. Oil demand rising is not the same inflation shock. So essentially, we kind of get the picture here. Investors are still firmly cautious and overly bearish, which is a really good catalyst if you are positioned correctly in the stock market. Because if we do get these easing financial conditions, and what easing financial conditions really look like is saying, hey, we've been able to slow inflation without destroying jobs. And now we can actually look at the future being the Fed's going to pause increasing interest rates and ultimately start to reduce interest rates. And with everybody being so bearish and sitting on the sidelines, either in cash or cash equivalents, or in positions like your staples, your utilities, which is generally very defensive, which is really where you wanted to be in 2022 is a good example. Those sectors are actually performing the absolute worst. Technology being the NASDAQ, if you just want to look at that index, that is by far been the best performing position of the overall market. And it's the largest sector of the market. That's why we're still firmly positive, even though February was a big pullback. I think the January growth that we saw, specifically in the NASDAQ's up 15% in January.
Yeah.
I think it was kind of borrowing from some of the gains that we might have saw in February. So the market got a little bit ahead of itself. And then we didn't get great news as it relates to jobs, like I talked about. We didn't get even better inflation news. Inflation was still down, but it wasn't going down as fast as it had from October and November and December of last year. Now, we still think that there's a nice uptrend since October is intact for equities because they bounced off the 200-day moving average. So this is definitely still a constructive sign. Basically, the market is taking everything that Chairman Powell said over the last 2 days in Congress with a grain of salt. They want to see the data for themselves. And this is very similar. Again, I'm going to go back to history here. So let's take a step back to 2009. And this is coming on the heels of the 2008 great financial crisis, which for everybody that was a market participant or working in the industry that I work in, obviously that was a very difficult year. And it was the worst stock market performing year since the Great Depression in 1929.
Yeah.
So let's get into history here a little bit. So 5 months after the March bottom, so March 9th, actually, March 9, 2009, which was my birthday, that was the beginning of the next bull market that we saw last for quite a while, over 10 years.
That's a really good birthday present.
It was. But here's what the data says. Here's what history has to say. So 5 months after the March bottom, investors were still saying that this is a sucker's rally, kind of like what we're seeing right now. And how many times have we heard pundits call this same thing in 2023 a sucker's rally? Well, guess what? This is what happened in 2009. In August 2009, 5 months after the March 2009 lows, pundits were calling this a medicated high. So was 2009 really an obvious bottom? No. I mean, everybody was saying it's a sucker's rally.
Yeah.
Exactly like what's going on right now. Nope. There were a lot of haters in 2009 for sure. Remember the famous new normal arguments about stocks entering a decade of subpar gains, which is, again, what we're hearing exactly right now. Or the Occupy Wall Street protests saying capitalism is dead. All of those things were happening back in March 2009 and even 5 months later into August. And obviously, we all saw the market rally for about, 12 straight years, something like that, or if not longer. And I wanted to give everybody a little bit more specifics. So I talked about some of the major questions or concerns investors have. Obviously, I have a bullish stance here for a lot of reasons, and historical evidence would support my stance. And we're going to get all the data again tomorrow and then all of next week.
Yeah.
But I have 6 reasons why we'll see a rally over the next 8 weeks. Right? So I'm calling for a nice rally over the next 8 weeks.
I mean, that's more than you can fit on one hand. So let's get into it.
All right. So let's start with number 1. The last of the hot inflation data was the fourth quarter of 2022. We saw unit labor cost at positive 3.2%. And beginning next week, we will be receiving incoming February economic and inflation data like we talked about, which we believe will show softer jobs. We're already seeing that already in the news that we got today. We'll get more tomorrow. And we expect softer inflationary pressures. This will reverse, to an extent, the somewhat alarming surge in inflation we experienced in January, as well as the jobs data. So that's number 1. I just flat out expect jobs to come more in line with what economists are expecting due to the fact that we have more people with jobless claims, which is the news of today.
Yeah.
And I also expect softer inflation. Now, second reason I expect a nice rally here over the next 8 weeks. And again, a lot of the data, by the way, for those that are new to the show, we subscribe to a lot of stuff. I'm a big Barron's fan, big fan of Tom Lee at Fundstrat. So a lot of this is certainly a lot of the work and efforts that they have. And of course, we get data from a lot of other resources from Charles Schwab as well. So second reason why I'm expecting a nice rally here over the next 8 weeks. So Fed Chair Powell actually kicks off this period with semi-annual testimony to the Senate Banking Committee and Housing Financial Services Committee, which happened over the last 2 days. Now, we expected Powell to reinforce the data-dependent message, which of course he did. And this means that 25 basis points is the path for March Federal Open Market Committee meeting, which we'll get March 21st and 22nd. Now, bearing any evidence of continued acceleration of inflation, which is what we're going to get Monday, Fed member Bostic said the same thing in his speech last week, that he kind of expects 25 basis point hike in March, and then we'll kind of be data dependent going forward and seeing what the inflation numbers are going to look like. So yes, Powell did exactly what we anticipated he was going to do because he doesn't have tomorrow's data, right? He didn't have March 10th data on Monday of this week. So he had to continue to be, measured in his responses as it relates to the questions that he received from Congress. Now, the third reason we expect a rally over the next 8 weeks here, The bond market will likely pivot dovish in March. The hot January inflation data caused the bond market to price in higher odds of a 50 basis point increase in March and April. And Fed speak seems to be pushing back against this. Remember, Powell used the word disinflation 13 times. So this means the Fed would be less hawkish than recent moves in bonds. And another big one is the falling VIX. So when we got that hot inflation, well, I wouldn't say it was hot. It just wasn't cooler than people were anticipating.
Right.
And obviously the jobs market came in a little stronger than people anticipated in February, coming from the January data. The VIX never really spiked, right? And the VIX is just a measure of volatility. It's just a bunch of options that are written on a 30-day basis on the S&P 500. Kind of gives you an idea of how the overall market is positioned, either bullish or bearish. And a falling VIX is very, very important here. And if the incoming data tilts the way we expect, being softer jobs, softer inflation, then bond volatility should fall, which supports a strong rally in March to April. That means the VIX could fall, and a falling VIX is supportive of higher equity prices. So even with some headwinds here recently in data, the VIX is still remaining very tame. Last year in 2022, the VIX averaged 25, which we haven't seen anything like that in a long time, really since 2008 and 2009.
Oh, wow.
So the VIX being where it is right now, hanging out right around 18, 19, 20, that's great. And I think we'll see that fall below the 18 level here with the data that we expect. Argument number 5. So seasonals are also a strong argument. We have been using the composite of rule of the first 5 trading days of the year. So this is looking at history. This has happened 7 other times where the market in the first 5 trading days is greater than 1.4% in the first 5 trading days of the year, a la 2023. We've already received that. Now, this composite implied market gains into February of 16th, which is pretty consistent with what we've seen so far this year, and a consolidation through early March, which again, we've seen so far this year. 2023 thus far is following this pretty closely, right? So the 7 other times that we've had the first 5 trading days be greater than 1.4% positive, it's pretty much falling right in line with what history has to say this year. So again, the market's made up of a bunch of human beings. We don't learn a lot from history, which means we tend to repeat our actions over and over and over again. 6th reason. The same composite now implies March to end of April will be a strong 8-week period for 2023 with a median gain implied of 7%. If 2023 follows this path, the S&P 500 could reach 4,250-ish by the end of April, hence that 7-8% rally over the coming 8 weeks. So that's the anticipation that we have. And a lot of it, again, is just strictly based on what history has to say relative to what we're going through right now. Now, outside of the historical evidence here, I wanted to share a little bit also about the concept of the market's too expensive. So we already talked about the forward S&P 500 X FANG stocks. If you look at sectors like energy, which has had a pretty stout year thus far, energy's PE ratio is 10.5. Right, and that was the only sector over the last couple of years that have been exceptionally positive. Now, if we look at industrials, which is another space that we like this year, with the government basically spending billions on chip factories and plants and infrastructure over the coming 10 years, industrials is an overweight for us. That's about 8.5, 8.9% of the market. We have an overweight there. Industrials PE ratio is 16.7. If we look at healthcare, 15.7. Financials, which should be a really nice place to generate some positive returns here if inflation is indeed falling and the Fed keeps interest rates higher for longer, which has been their mantra all year long. Financials would be a nice spot to have an allocation to. PE ratio of 11.4%. I just mentioned energy at 10.5. Now, if you actually include FANG into all of this, earnings per share forward in 2024 is 22.7, which is actually much lower than what the overall NASDAQ's historical long-term average for PE multiple would be. So I would argue that we actually have a, if not fairly priced, and undervalued market, at least in certain specific industries, which is great for the individual stock investors like ourselves here, because it really truly is a stock pickers type of market. No question about that. Now, technology is still the favorite sector. So the 11 sectors of the S&P 500, technology is about 25% of the overall market. The second largest sector being healthcare is about 13.5%. So if you're going to have a bull market rally, tech's going to be a big part of that. So tech is our favorite sector pick, and I do expect this to be led by the FANG stocks. We're certainly overweight in that, and it's been a hard spot really over the last I'd call it close to 15 months.
Yeah.
It's been a tough spot to hold the position in, like holding ground.
Uh-huh.
That's a difficult one, no question about it. But the reason why we like the technology position, specifically FANG, the buzzword that everybody's hearing, and we've talked about this in other podcast shows, so you don't have to take my word for it. Go check out some other recent shows here, and you'll see the exact same thing. Matter of fact, go read the newsletter on our website, shepherdwm.com. I'll point this out. Is that artificial intelligence is the new buzzword, right, in tech?
Oh, yeah.
So I don't know if this means we're going to be more like RoboCop here in the future.
Like a cyborg?
Right. Yeah, we don't know. But here's where I'm going with this. So there's been other points in time in history where we've had a quote-unquote labor shortage.
Yeah.
Right? If you look at history back in the 60s, definitely the 70s, even parts of the 80s and early 90s, there's been a quote-unquote labor shortage here in the United States market. So what can CEOs do in corporate America? Because they have earnings they got to hit, right?
Yeah.
Wall Street doesn't give a damn whether or not you can put somebody to fill a task. You just want to see results. So what can you do if you got to play that dance as a CEO every single quarter? You can just take in the shorts. That could be one option, do nothing, and just blame it all on the fact that, we can't get, cloning approved for people, or, Congress is not going to pass any sort of immigration laws and things of that nature. What are you going to do? You're going to automate things, right? You're either going to get a piece of software to do that task, or you're going to create a robot. I'll have my RoboCop, sort of example there.
Yeah, well, I don't mean to be a stickler, but RoboCop is a cyborg, not a robot.
You're right. So that's out of my area of expertise.
Yeah.
Good movie, though, if you guys haven't seen that.
Excellent. I mean, all of them.
So that's the reason, or that's how the technology sector grew into 25% of the overall market. If you go back in the 60s and 70s, the biggest sector of the market is industrials, right? Everybody talks about the good old days of the United States economy, and the backbone of that was manufacturing. It was 100% true coming out of World War II. I mean, that's a big reason why the United States economy really exploded post-World War II. Now, again, because we can't clone people yet, and nobody wants to wait on maybe down in different parts of the world, you can probably figure out a way to clone somebody. But since we can't do that and we can't pass an immigration law, nobody wants to wait around for that. CEOs are going to spend money on technology. How can I automate and or get a piece of software to fix this? And that's exactly what artificial intelligence is all about. It's either going to make a person or an entity or a group of people more efficient,
right?
Or those people are going to have to find a job doing something else,
right? Because
now a piece of software has now replaced you. So that actually is a healthy thing from an economic standpoint, where we can actually get people to do more important tasks as opposed to copywriting is the easiest thing. So all the copywriters out there, they're probably scared to death with the new Chat GPT thing. But that's it's coming, right?
I mean, yeah, you can point to all kinds of different innovations that are no longer just thoughts, that they're actually realities. And as soon as the kinks get worked out, I mean, for example, you ever seen that movie Logan?
Yeah.
One of my favorite details about that movie is when they're fighting on the highway, all the trucks, the semis they're driverless. They're just on autopilot.
Exactly.
Right.
Yeah.
And that does suck for people who need to find a new career. But if we have any kind of foresight, we can prep people, get them in newer jobs while still making these innovations come through that actually make life better, right?
Absolutely. And
maybe the whole 40-hour work week goes away. If people are more efficient, maybe it's 30 hours and you got a little more time with your family. I don't see anything wrong with that.
Yeah. Or you can just, that other time that you're not doing your day job, you can start a small business.
Start a small business, yeah, or provide childcare. Do something that is rewarding and contributes to.
And that's why I say, yes, it's unfortunate there's some people who are going to have to figure out another way to support themselves and their families, but it does actually make the economy better.
It does. And if we know these changes are coming, maybe we could take a page out of Mr. Buffett and yourself's book and learn a little bit from history and start to prep for these inevitable changes.
Absolutely.
I'd like to see that. But
absolutely.
I'm still waiting on my clone. So,
I don't know if the world's ready for that. As if
for two of me,
two of you,
oh, we dominate.
Probably, no doubt, no doubt, be more efficient with your time.
I put one in Wyoming and just run it.
I like it.
I'm just kidding. Wyoming's great.
It is. And just to get back to my point on FANG, so far this year, even with the pullback that we saw in February, FANG is actually outperforming the S&P 500 by 1,180 basis points, which for those of you that aren't familiar with basis points, it's a lot. It's a lot. Now, technology obviously is doing very well so far this year. Defensive have been terrible. And if the whole market, right, not the whole market, because obviously there's people like myself that have a bullish position in the market and others don't. It's clear in the data that's overwhelming majority of people are bearish. You can't even debate that right now. And if the majority of the market is anticipating a recession and they're hanging out in places like utilities and staples, that's been the absolute worst performing sector year to date by a long shot. Healthcare has had a rough time so far this year. And those were all the sectors that did great in 2022. And people were calling for a recession and it just didn't happen. Even though you could look at it and say, I would argue that we had the recession last year. You just couldn't actually officially call it that.
Right.
Because you did have 2 consecutive quarters of negative GDP. You did have all these issues with, labor markets and so forth.
Yield curve.
Yield curve was the issue also. The labor market said, no mas, man. We're not having a recession here because everybody that wants a job can find one.
Right.
Right. And that's the reason why we couldn't officially call it a recession in 2022. So if everybody that says the yield curve was inverted, that's what causes a recession, I agree with it. It just happened last year.
Right.
It's not happening in 2023 in our view. So all the people that are calling for a recession this year that are hanging out in defensives, you've really been substantially underperforming the market thus far. And maybe you're right. Maybe the inflation data on Monday is going to come in red hot. I just don't see it. I don't see how that could possibly happen here with the fact that, housing may not be completely showing disinflation. But if you actually ask anybody in the marketplace, a realtor, somebody that owns a home, or somebody that owns rental property like myself, that's not a problem anymore as it relates to inflation and housing.
Yeah, well, and the housing has the longest lag effect pretty much of any sector, right?
Mortgages, it shows up right away.
But yeah,
all the other stuff like the owner's rent and so forth, like, if my tenants, they sign a lease once a year.
Right.
So it takes a minute for that to show up in the inflation data.
Yeah.
Right. We're about to start to see that though. And Powell himself even said, hey, I can see, how there's going to be disinflation in housing. It may not show up in the data immediately, but we can see that that's coming. So even he admitted all of that. So I don't see how we're going to have inflation coming and ripping hot in any way, shape, or form here.
Just like the devil on cocaine just shows up, just ready to tear.
Absolutely. So some key moments here, as I don't know where we're at on time here, since I don't have the clock in front of me now. We're doing this YouTube live.
We're almost 33 minutes in. A good show today.
Time flying by here. So as I mentioned, tomorrow, March the 10th, 8:30 in the morning Eastern time, the Fed's we're going to get the February employment report. On Monday the 13th, we get a Fed survey on inflation expectations. And of course, we get all the CPI data from February on the 14th. PPI, what it costs for companies to produce things on the 15th at 8:30. And then on March 17th at 10 o'clock, we get the University of Michigan preliminary one-year inflation expectation, which is very, very important too. I think Powell mentioned that recently, is the expectations of consumers here in this country's thoughts of inflation are very important, because if he were to just say, let's say sometime last year that we're just going to pause rates for a little while and see what happens. If inflation didn't go down under those circumstances, now people are just accepting the fact that we have high inflation and this is the way it is. And that expectation is a problem. That's what keeps inflation very, very sticky. And a lot of other countries have learned that hard lesson. And that is the reason why he didn't want to pause last year. But I think the data is going to be overwhelming to the point to where he's going to have to start to acknowledge the fact that raising rates no longer makes a lot of sense, given the fact that I expect inflation to show a lower than expected number, which would give him the reason to start to speak those same words to the rest of the world.
I hope you're right. It certainly seemed, that first announcement where he mentioned disinflation 13 times, that was, hopeful, made me feel hopeful. But then this last time when he was talking, I was like, oh, man.
Yeah, a lot of people are calling for 50 basis points, all these inflationistas, I guess we can call them that.
Love it. Get that on a T-shirt.
To me, this is data reactive.
Data reactive.
Yeah, instead of being data dependent, because you got 3 straight months in a row of disinflation. You got 1 month that showed a little hotter than expected inflation. It still was coming down, just not as fast as the prior 3 months. Yeah. So to me, the February, knee-jerk reaction, again, this is going back to human beings being hardwired with fear and greed, right? Got real greedy in January, right? 15% in the NASDAQ. It was awesome.
Yeah.
And now they're letting the fear kind of take over their emotions here a little bit with the higher than expected jobs report from January and the higher than expected inflation number that also came from January. To me, that's a seasonal adjusted sort of number, should be accounted for. Again, I think that's the reason why the VIX didn't spike, and I think that's the reason why February wasn't, the end all be all where it took away all of the gains, from January. So I think that was more of a data reactive moment. But we do expect Powell to emphasize that rates are near neutral coming out in March 21st, 22nd for his next announcement. So there is less of a need to be higher in a hurry, in our opinion. And that makes the market happy because now they have a pretty good idea of what the Fed is going to do going forward as it relates to interest rates. And we can start to just focus on, what corporations are saying and doing relative to their earnings announcements. All right. So in conclusion here, and I'll start taking some investor questions, there's a lot to look forward to, in the coming weeks from an economic data standpoint. And we'll be eagerly awaiting the jobs and inflation data like the rest of the world for sure. I do understand, as I hope all of you do, that historical performance from the past is not a guarantee of future results, but we must learn from history. We would be bound to repeat our mistakes, as Warren Buffett put it. What we learn from history is that people do not learn from history. And that was a summary of the newsletter I sent out to everybody. You can check that out, shepherdwm.com. And here pretty shortly, you'll be able to actually download the Shepherd Wealth Management app on any device, Android or Apple.
Yeah.
With that, let's get to some viewer questions, if we have any. Nothing yet?
Nothing's come through the text line today.
All right. So a lot of people are, getting their taxes prepared here at the moment. So let's talk a little bit about that. So I had a pretty high net worth client that we did some tax planning for, and essentially they had a real estate piece of property, that they had sold, and there was a significant capital gain. And obviously, paying taxes is just a function of making money. So first and foremost out there, we used to talk about this all the time back at Fidelity and TD Ameritrade days when I was an employee there. We never want to give advice to a client where the tax tail is wagging the dog, so to speak.
Yeah.
What I see a lot is people that will not sell a position where they've made money on it because they don't want to pay taxes. Now, I understand that, but if you hang on a position too long, then it can go the other way as well.
It's like wine. You got to drink it when it's hot, baby.
That's good advice.
Yeah.
And that happened in 2022. The people that did not rebalance their accounts coming out of 2019's double-digit return in the market, 2020 double-digit return in the market, 21 was a double-digit return in the market. If you did not take profits off the table, in other words, you didn't rebalance, the market's going to rebalance your portfolio for you. It's just going to do it in a very unkind way.
Yeah.
And great. Now you don't have to pay taxes. But wouldn't you rather have that 50 grand that you made on your Apple stock? I would rather have that and maybe pay 15% in taxes if you're a long-term shareholder.
Yeah. That sounds great.
Sounds like a fair trade-off to me.
Me too.
So here's the scenario. All right, so we had to do a little bit of tax preparation. So they sold a piece of property early, I want to say Q1, maybe beginning of Q2 of last year, 2022. Made a nice capital gain on that. And obviously they were anticipating the tax that's associated with that. Now, as we go through 2022, obviously the market, did what it did. NASDAQ was down 34%, S&P was off 20%, and the Dow Jones was down, I think, around 8.5% or so. Again, the only sector that was positive was energy. And before we actually consolidated some additional accounts, what we also noticed as we're doing this tax preparation, that the client had a bunch of different mutual funds, right? Some other institution. I wasn't managing it at all. So we're looking at all of that. And the one thing that the client didn't understand about mutual funds is they're required by law to send out capital gain distributions in December before the calendar year is over. They have to send out 90% of all their capital gain distributions. So you can have a year like last year, if you were a mutual fund shareholder, where you are paying a fee. It's called an expense ratio. You're not seeing that fee on your statement, but it is in fact the fee that you're paying just to own the mutual fund itself. So you're paying a fee. The mutual fund itself lost money, right? As almost everything did in 2022. And in a taxable account, that 90% of the capital gain distributions that the mutual fund sent out, it's also taxable. So you got a triple whammy here. Paying a fee for something that lost money that you have no control over what's invested in.
Yeah.
And you're paying extra taxes.
Yeah.
Seems kind of dumb to me.
Yeah,
so
here's taking it in a keister right there.
So here's what we did. We consolidated the account.
Yeah.
We custody all of our client accounts at Charles Schwab, right? The reason why we do that is I was, again, a former employee at TD Ameritrade, and Charles Schwab bought TD Ameritrade. It's all becoming one company as we're speaking here this year. So all the accounts are going to end up there anyway, and Schwab has a nice platform, and now they're going to benefit from all the same cool technology that TD Ameritrade had. So I'm very comfortable, obviously, with the TD Ameritrade platform. So we brought it all to Charles Schwab, and then we looked at exchanging out of those mutual funds, not just to individual stocks, but also to some ETFs. So why ETF? For those of you that aren't familiar with that, ETF stands for Exchange Traded Fund. Most people are familiar with mutual funds because that's what you have to invest in through your company-sponsored 401k plan. Usually, they don't give you any other choices.
Right.
And that's the big reason why this particular client still had mutual fund exposure. They just didn't know any better, didn't know that there were equivalent alternatives, such as an ETF. So what is an ETF, real quick? An ETF is a diversified investment, just like any mutual fund is. Typical mutual funds going to hold, 250 to 500 different positions in most instances. And an ETF is just as diversified, right? You can pick an ETF for the healthcare sector, right? You'll probably see several hundred different individual healthcare positions inside of the ETF. The difference is in a taxable account, ETFs are not required by law to send out capital gain distributions. You're just going to hold on to the same positions and the same weighting, and they're going to ride that out. So it's a much more tax-efficient vehicle, again, just as diversified as any mutual fund out there. And typically, because you're not trading a lot inside that ETF throughout the calendar year, the internal cost to own the ETF is generally substantially less for a customer. The average cost of a mutual fund in this industry is right around 1%, which means some are higher, some are lower. And the average cost of an ETF in this industry is right around 30 basis points. Again, some are going to be higher, some are going to be lower. So it's a much more tax-efficient vehicle. It's just as diversified as any mutual fund would be. And it's much more efficient tax vehicle. Like I mentioned, it's a lot less expensive, right? Internal cost of ownership there. So we took them out of the mutual funds. We were able to sell them at a loss. Again, the mutual funds were losing value, like almost everything did in 2022. We got into a much more tax-efficient vehicle sort of situation. And because we were taking losses on the funds purposely, at the end of the year, 2022, we were able to actually offset all of the gain from selling the real estate property with the losses from the portfolio itself.
Wow.
So essentially, either tax neutral, they may get a refund. We're actually working that out right now with our accountants on our team here. So that's a big part of what we do here at Shepherd Wealth Management. The value that we bring to the table, of course, we're here to help out and perform from an investment standpoint. Of course, I'm here to help out with your retirement planning, whether you're not retired or getting ready to go into retirement, or if you've been in retirement forever. We're here to plan, not just to perform, to sustain the lifestyle for a customer, but you have all these other pieces involved, such as tax preparation. So we actually have a team of CPAs and bookkeepers that are working right alongside of us. We also have estate planning attorneys working right alongside of us to help out with things like estate planning, which is another quick thing I'll hit on here in a second. And we offer all of these services for those that have $500,000 or more in household assets. We actually offer all those services of tax preparation and filing, estate planning, as well as all the investment and retirement stuff at one low price, 1% annualized. We bill in arrears, and it's assessed quarterly. And not only do we do that, of course, we provide all the newsletters every month, all the shows that we do here. But we also, are very passionate about, servicing our customers and doing in-person quarterly review meetings to discuss all these different things. And we're not here to talk for an hour in most instances, because if a client's catching a newsletter, maybe a podcast, something like that, by the time we sit down 3 months later, they're pretty much going to know exactly where my mind's at and why and what data that we have to support all that.
Yeah.
And as it relates to that, while we're doing the same sort of conversation, this is, again, a higher net worth client. And all the Trump tax incentives are rolling off in 2025. One of them was an estate planning lifetime exemption. So right now, if you're a married couple, which they were or still are, if you have more than $11 million in assets per person, so in this instance, $22 million, if you have more than that and things aren't titled correctly, anything above that $22 million threshold, if they were to pass away, they would actually have a 40% estate tax on anything above that, right? Unless things are prepared and titled appropriately. Now, in 2025, that's rolling back to like $6 million per person, right? So it's almost getting cut in half. So it's going to affect more people. Now, this is a first-class problem to have, even if the husband and wife each had $6 million to $12 million total by 2025, and they had to get an estate planner involved to title things correctly and maybe cost $1,500 to $2,000. I'd say it was money well spent.
Yeah.
But they don't know. The truth is, they just don't know these things because it's not their job. their job is to be retired, right? They're not sitting here looking at when, tax laws are going to change or any of those types of things. So by having an in-person quarterly review meeting on top of all the other things that we provide, make sure that we don't let something simple like that fall through the cracks that could otherwise be a very difficult thing for the beneficiaries to go through. And I would be in a lot of trouble, quite frankly, because I'm a fiduciary. It's my job to understand these things and bring it to their attention.
Yeah.
And not everybody wants to move when I bring stuff like this to their attention. That's great. We just make a note on that. But had we not had these discussions, then we would not be able to plan accordingly for them and their families. So that's a little bit of a recap of our last monthly newsletter of what's happening in the market, why it's happening, kind of our position on it, why we feel that way relative to history, and also wanted to share with you all some thoughts and questions, concerns that I've received from clients, as well as a recent actual true example of what a good conversation with clients looks like from a planning standpoint to avoid these tax consequences, both in the calendar year that we're working together and going forward. So it was a blast. I think we're right up on our time here, Ez.
Yeah, we are.
And certainly enjoyed doing this one. We're going to do it again in a couple of weeks. We'll obviously have all the data that I just kind of talked about in our hands. So we'll see what the picture looks like. I'm either going to look like a hero or a goat.
Or maybe the goat.
Maybe the goat. It could be. But really enjoyed doing this. We'll make more announcements as the app comes out, but don't forget to go to shepherdwm.com. There's a whole bunch of background information about myself, the company, our president, and you can certainly catch any of our podcast episodes right from our website. You'll be able to get all the newsletters there, and we're going to start doing a weekly blog as well. So a lot of exciting things to announce. Look forward to that. And with that, I hope you all have a great rest of your Thursday, March the 9th. I know I will. And after that, have a great rest of your weekend.